Historically, see, if you look at this, कि ये Fed ने rate जब cut किया, 2001 there was a recession, 2008 there was a recession, 2019 we had a slowdown but no recession. So that is why we are saying that everyone is very excited that the Fed will cut rates and it's good for the markets. Yes, it's good for the markets only if there is no recession, because if there is a US recession, we have heard the phrase, when the US sneezes, the world catches a cold. So if you have rate cuts because there is a big recession in the US, you will see some downside in the markets. So that is what we have to keep a watch on. Fed cutting rates is good if the US doesn't go through a recession, but if there is a recession, we are watchful of that. The second is
Today only
that's on the
I was just reading the Jim Walker's some economy. He was saying that only 6% people are sort of expecting a recession on the US, and Jim Walker is one of them.
Okay.
Sort of. In the
So to be honest, in markets, my experience has been what the least number of people expect happens.
I was just touching that point.
So, but we are keeping a watch on it. So, I'm not here to paint a doomsday scenario. I don't know if a recession will happen or not, but we have to keep watching for it. And in the past, whenever this has happened, global markets have cracked. India will also crack. We will not be safe from any correction as such. So that's on the global plot, and you know that there are plenty of uncertainties. Trump has come in; he's threatening everyone with tariffs across the board. So it's not a scenario where there is a green signal globally that things are all hunky dory. We have to be careful. Second bit is on the domestic thing. We know the GDP growth in Q2 was bad. Q3 is expected to be better. These are the high frequency data points. So this indicator is made by Jeffries. It's not ours. They combine, I think, 100 plus parameters together and come up with a combined indicator which tells us where we are in the cycle. So see, this is around September when this indicator had really come off, and we saw that Q2 GDP growth being 5.5%. We are seeing some recovery in this, but we are still below these levels. So if you look at the absolute level, it's still below these data points. So there is some recovery of a very low base, but the economy hasn't improved very dramatically. So we are still in a bit of a slowdown. We'll have to wait and watch how the GDP numbers pan out. When we speak to companies across the board, people are still talking of a slowdown. They are still saying 1-2 quarters, for the next 1 or 2 quarters, we are not seeing any meaningful improvement in demand. And this is for most companies across the board as such. The next bit is on liquidity. So domestic liquidity is very important. Domestic liquidity, the way it's measured is key. How much surplus funds banks park with the RBI every night. When this is in positive territory, we are in surplus liquidity. Surplus liquidity when the banks are flush with cash, they are ready to lend. They can lend to corporates, they can lend to individuals, etc. And bank lending is nothing but the grease that drives the economy. So when we are in surplus liquidity, it means that plenty of lubrication is available in the economy moves faster. When we are in a deficit, it means that things are tight, banks are pulling back, and this time around banks are also pulling back because there is an NPA issue, especially in retail lending. So tight liquidity plus NPA issue means banks are pulling back, and that is one of the primary reasons, or not the only, but one of the main reasons why we have seen in this a slowdown in the economy. One has been the government spending last year during the election season has been quite weak. The second has been banks have pulled back quite meaningfully from lending. If you see the credit growth rates, 1 year ago we were around 18-19% YOY. We are now at 10-11% YOY. So that big delta has caused a slowdown in the economy. One other reason for this surplus liquidity to decline is because of FI outflows. Money is leaving the country. We are in a scenario where balance of payments is negative, which means that net outflows from the country. In the past, there are very few years where you see balance of payment negative. We see negative current account deficit. It gets compensated by positive FDI plus FIF flows, and you see a surplus of balance of payment. A surplus of balance of payment results in increase in reserves. So that is why reserves always keep going up. 5-6 years ago, we were at $300 billion. Then we peaked at close to 700 billion. Now we are at $600 billion, and that is because FIs are leaving the country. or FII flows are leaving the country, net negative BOP also puts a strain on the liquidity. So that is the current challenge that we are facing. The next indicator is most indicators appear to be slowing down. This is more text than data, but these are the key things that we are monitoring. And as and when these things improve, we can say that the economy has really turned around. So GST collections is very important. I think Jan was better, but last year till December, this number has really come down. I think the lowest was some 7.5% YOY, which is quite low. FY24, we were trending close to 14-15% on a YOY basis. Credit growth is slowing down, as I highlighted. Power demand has slowed. So this year, FITD power demand is below 5%. Auto sales are again in single digits. The PV sales as well as two-wheeler sales, CV sales. You look at all the three broad segments, these numbers are in low single digits to mid single digits. So a lot of the high frequency indicators that we look at are subdued, and we are yet to see a broad-based meaningful pickup as such. Next bit is liquidity. So we did the global and domestic macro. Next is liquidity, which is flows. FI flows have been negative. We all know that. Nothing new. The big hope has been on domestic flows, but we always have to remember that domestic flows are cyclical. They always don't trend up. So if you see 2005, 6, 7, 8, very good flows. Then we had 5 years where the industries were net redemptions. This is net mutual fund inflows. Again, from 13 to 17, we saw a sharp uptick. From 17 to 19, this was a declining trend. Again, in this cycle, from 20 to 24, we have seen a very sharp uptick in flows. Flows have almost gone 3 to 3.5x, from 1,20,000 per year to 4 lakh crores per year. Markets move very dramatically when the level of flows has a very big delta. So if you see in 21 to 22, there was a big uptick in flows. Markets did very well. From 22 to 23, flows were at a very healthy level, but they were flat. Markets didn't do that well. If you remember, we had 2 years of sideways to flattish markets in 22 23. Again, from 23 to 24, flows doubled, and we saw markets doubling, tripling, depending on the index that you are looking at. So unless and until flows go up meaningfully from here, you will not see a very big delta in terms of the market movement. We'll have to wait and watch. For the last 6 months, flows have been steady, but they have peaked at 40,000 crore net. They are not crossing that level. This month is looking more like 35,000 crores till now, looking at the data that we are getting as such. So these flows are not going up. The second bit is the color of these flows is also a bit concerning. We have highlighted mid cap, small cap, and sectoral funds. If we look at it, this is till November 24 because that is when this data was compiled. 3.5 lakh crores were the net inflows till November, out of which almost 18,000 to 20,000 crores came in mid cap, small cap, and thematic. So these are not very sustainable flows. You can say this is a bit of hot money because when the markets do well, people tend to chase themes or mid and small caps. And this is what has happened. Traditionally, you would see that 60 to 70% of flows go into flexi, hybrids, large caps, etc. 30 to 40% go in mid small thematic. This year or the last year, it has been the complete opposite to that extent. So the nature of flows is also worry, because if this reverses and flows get pulled out of mid small thematic, that could result in some pressure in these categories as such. Next we come to earnings. We did macro, we did liquidity or flows. Next bit is earnings. So earnings, if we go back 6 months or 9 months, earnings was the one thing that was keeping the markets up, because these were the estimates. So if we see FY25 growth, this is as of September 30. If you look at the data on September 30, FY25 growth, this is almost in the bag. FY26 was expected to be 19% for Nifty, 23% for mid cap, 30% for small cap. These were the expectations. Fast forward to 24th Feb, which is now. Nifty has been cut from 19% growth to 13.5%, mid cap from 23 to 13, small cap from 30 to 9. So the argument that mid and small caps are growing much faster and they should get a higher multiple gets challenged over here, at least for next year, because Nifty seems to be the fastest growing index of the three over here as such. So this is where the story has changed quite dramatically. From a 25 to 30% earning growth in the mid and small cap space for FY26, we are now down to a 10 to 13% earnings growth in the mid and small cap space. And the next is if you look at the current correction, we would see that the correction has been quite meaningful. Nifty is down 12, small cap index is down 22. So it looks very healthy. But if you look at the PE correction, it's hardly anything. For the small cap index, the PE correction is only 5%. It's in fact less than Nifty. That is because the earnings cut has been so severe. The small cap earnings have been cut by 16.5% from September till now, whereas Nifty earnings have been cut by only 5% from September till now. So valuation correction in Nifty is higher than small cap. Even I will argue that mid cap B, this earnings cut is quite benign. This quarter, this number will go up quite meaningfully. Mid cap has a lot of capital market oriented companies. As the markets have corrected this quarter, you will see the earnings cuts for FY26 in all these capital market space as well. So earnings cuts is something that you have to be wary of because you can get, or people can get excited looking at the 20% correction in small cap, but valuation correction is only to the tune of 5% because the earnings cuts have been quite significant over here. If you look at valuation, which is the large bit, I hope these charts are visible. So this is Nifty. Nifty is close to average. So if you look at 10 year, this yellow line in between is the 10-year average P of Nifty. 10-year average P is 18.2. Currently we are at 18.6. So there is hardly any froth. Even if you look at the last 5-year average, this gray line is the last 5-year average, which is around 20. We are currently at 18.6. So we are less than 5-year average. And if we go back to 15 to 19 period, the average was around 17. So if someone is really bearish and argues that this P will go back to these levels, where the economy now is much better than what it was over here. But even if Nifty goes back to these levels, it's 18.5 going to 17, barely a 5-6% correction. So my argument is Nifty valuations are very close to fair levels. There is not much froth in the index. But if you look at the mid cap index, for example, average P over the last 10 years has been 22. Currently we are at 28. We are in fact above the 5-year average as well. We haven't hit even the 5-year average PE over here. And if someone argues we go back to the 14 to 19 period where PE was 19, we are at 28, the drawdown can be quite meaningful. I hope we don't go here. I hope we settle somewhere over here. But still there can be a 15-20% drawdown in the mid cap index. The same is the story for small caps. Again, long-term average PE of 16. Currently we are at 20. 5-year average is at 19. So we are above 5-year average, much above 10-year average, and significantly above what was 14 to 19. So that is where we are. Nifty is largely fairly valued. If you invest money in large cap oriented products, you won't lose money in a meaningful fashion from here unless and until there is a big global event like a US recession, COVID, etc. Whereas mid and small cap, for the fraud to come off, these valuations have to go from year to year. That is when the markets become fairly valued and you start evaluating opportunities as such. This is again, everyone talks about the long term. My argument is don't forget the short term. This is a ratio chart. It's a ratio of the mid cap index to Nifty, and it trends upwards. So if you look at this, is a 20-year ratio chart from 2001 to now, 25-year in fact. It trends upwards. Trending upward means that over the long run, mid cap outperforms Nifty because that is why the chart is trending upward. It's a simple ratio, which is mid cap to Nifty. But in between the long-term uptrend, there are these cycles. So if you see 2001 to 7, mid cap significantly outperformed Nifty. That is from the bottom to the top. But from 2005, 6 to 8, 9, mid cap significantly underperformed. Again, outperformance, underperformance, outperformance, underperformance. Now we are here. So that is why over the long run, yes, mid caps will outperform Nifty. But there can be cycles of 2, 3, 4 years where Nifty can outperform the mid and small caps, and we are somewhere close to the peak of the cycle. So there is a high probability that Nifty or large caps can, if not out, well, they'll give you at least the same return as mid and small cap. They can also potentially outperform mid and small cap. So that is where we are in the cycle. Again, don't forget Nifty. It's a similar slide. So we have been hearing a lot of chatter on SIPs in small caps. So some people are saying stop SIPs. Some people are saying don't stop SIPs. Here I am saying कि small cap तो ठीक है, don't forget Nifty also, because I have taken an example of someone doing a very long term SIP. So suppose you started a SIP in December 2003, monthly SIP, December 2004, 5, 6, 7, 8. So these are 5 different SIPs that you started. You started in small cap. The SIPs that you did in 4, 5, 6, 7, 8. So 4 is at the start of the bull market, 8 is at the peak of the bull market. And I've taken various drawdowns. So 2009 was a drawdown, 11 was a drawdown, 13 was a drawdown, 20 was a drawdown. And this is the current. So current, the CAGR is very healthy between 11 to 13% CAGR. There is no issue. Small cap CAGR is very good. But even in March 20 at the bottom of the market, your SIP would have been negative. जितना पैसा इन्वेस्ट किया उससे कम would have been your corpus. After investing for 4 to 20, which is 16 years, you would have been barely positive. After investing for 12 years, you would have been minus 2% CAGR. End result is good. If you look at Nifty, very rarely you get these negative instances. So even at the bottom in March 20, you would have made 5 to 7% CAGR. Even in September 13, which was close to the bottom of the market, you would have made 5 to 10% CAGR. Current CAGR is again 11 to 12%, not very different from small cap. One category which has outperformed is mid cap, but that too only in the current bull market till March 20, September 13, December 11. A SIP in Nifty would have outperformed mid cap as well as small cap. The current bull market has helped the small cap to significantly outperform Nifty. So the key takeaway is all 3 indices are important. Follow asset allocation, larger weight to large caps, lower weight to mid and small caps. Don't forget the Nifty. It can give you very steady, good returns. Returns are good. You see 12% CAGR versus 12% CAGR. But these are very steady. You don't, even in the bottom of the market, COVID bottom maybe you did not see negatives over here, but you saw negatives in small cap. So just as a thought, don't forget Nifty.
So this tells you that all these 5 dates are basically bottom of the
bottom
cycle.
of this. Yes.
And if you started on December 2003 or any each year, and if you ended here, what
Correct.
was the reason as a SIP return?
Correct. Correct. So if I started on December 2000, because someone says कि peak of the market में मत start करो, someone says bottom में मत start करो. I'm saying if you start at the peak or bottom doesn't matter. Over the long term, your returns are not very different because
Correct.
you are averaging.
Correct.
But what matters is जब ये period आएंगे बीच में, will you have the gumption to hold on?
Correct.
Continue your SIP because you
Correct.
make money only if you continue your SIP. Na? So mid and small cap में ये problem, or you might need the money in 10 years.
Correct.
You started in 2007-8 and you needed the money in 1920 and you would have not made any return. जबकि Nifty में you would have still made some return, which is at least FD return ना, तो मतलब अपने पैसा खोया नहीं वहाँ पे. So that is why do asset allocation. When markets are cheap, increase your SIP in small cap. When markets are like we are today, increase your SIP in Nifty. So थोड़ा rebalancing करना जरूरी है, and don't just blindly invest in mid and small caps, because I see a lot of narrative where people say small caps will always outperform. They do outperform over the long run, but there are periods like this where they can significantly underperform, and we have to be careful.
So combo is basically a flexi
Combo
cap.
is, मतलब that's from a fund side, but अगर आप personally भी कर रहे हो तो have large cap, flexi cap, have mid cap, have small cap. Don't go in only one category as such. Because that's on the market outlook bit. I will quickly cover one fund which is quite relevant for today's markets. So it's a multi-asset allocation fund. I'll quickly run through how we have positioned. You will know that there are enough multi-asset funds in the market. This is how we are positioned. Fixed allocation. We don't do any rebalancing. We do rebalancing, but the rebalancing is to get the allocation to these levels every month. We don't change the allocation as such. The way we position it is 50% domestic equity, 25% dollar assets, 25% fixed income. So 50% domestic equity is obvious, 10% international equity plus 15% gold silver. This is 25% dollar linked assets and 25% fixed income, and you get equity taxation because 50 plus 15 is 65, which is equity taxation. So it's a good all weather fund कि rupee depreciate हो रहा है तो 25% dollar linked assets है, उसमें gold silver है, gold is doing very well, तो you are okay. International equity is doing very well. China is doing very well now. Brazil might do well. So that comes through over here. The weight is not very meaningful. It's only 10%, but ठीक है, you are covered. मतलब it's a good asset allocation product. You have exposure to everything. And fixed income and arbitrage protects your downside in markets like today as such. उसमें भी ये जो domestic equity है, we are running a 50-25-25 portfolio as of now. 50% large, 25% mid, 25 small. The idea is to give asset allocation solution through one fund. अगर आपको एसेट एलो ज़्यादा सोचना नहीं है, वन फंड में डालो जिसमें 50 इक्विटी रहेगा, जिसमें भी यू विल गेट लार्ज मिड स्मॉल एवरीथिंग, यू विल गेट डॉलर एसेट्स, यू विल गेट फिक्स्ड इनकम. How has it done? So the proof of the pudding is in the eating. It was launched on 1st Feb of last year. From 1st Feb to September when the markets peaked, I think ये next chart पे है. हाँ, Nifty 500 went up some 25%, Nifty went up 21%. Actually, this is a Nifty substitute, तो Nifty भी डालना चाहिए यहाँ पे. Nifty went up 21%, the fund went up 20%. In the correction, the BSE 500 has fallen. अभी तो ज़्यादा है, ये 29 नवंबर तक का ही डेटा है. But if you look at till today, market has fallen around 14%. The fund has fallen around 7%, मोटा मोटी. So through the cycle, it has been able to capture 90% of the upside, but on the downside, it has fallen half that of the index. I think ये पहले का डेटा है क्या पूरा तो? हाँ, ये this is till Jan. So from inception till Jan end, fund is since the peak to the bottom till Jan end, Feb का डेटा नहीं है इसमें. Nifty 500 was down 5%. The fund was down 5.5%. So 12 versus 5.5, and upside तो I already told you as such. तो that is how it works. We have back tested because सिर्फ एक ही साल पुराना फंड है, तो we have done back testing. So if you look at 3 to 5 year CAGR, which is more relevant, on average the fund has given 11.5% return when Nifty has given you 13% CAGR. So it is around again 85 to 90% of Nifty return capture करता है. But on the downside, the volatility would be half that of Nifty. So even in these years when Nifty was down 32%, the fund was down only 15%. So that is what we are trying to achieve, 90% of the upside in up markets, 50% of the downside. So backtesting से भी वही conclusion आता है, actual fund performance is also very similar. And this is the key takeaway. Again, I will not go through it, and these are some of the details की fund portfolio क्या है, etc. etc. So that's it about from my side. If there are any questions, comments.